Today my presentation subject is managerial economics, starting with the beautiful name of Almighty Allah, who is the most Rahman and Rahim and also Qadir and Qadir. I'm a student of Department of Business Administration, University of Sindh, Campus Larkana. And this is Abdul Razaque from BB1 at batch. My roll number is 5. Subject is Managerial Economics, submitted and presented to the Mem Shagufta Salim Sheikh. Outline topics in nature and scope of economics, accounting profit and economic profit, time value of money, demand and its analysis. Economics. Economics is the study of how individual and societies make decisions about ways to use scarce resources to fulfill wants and needs. It is a social science. It deals with the study of human behavior in a society and the process of production, consumption, exchange, contribution, distribution of goods and services with a given sources. Branches of economics. Microeconomics means small or individual. The term micro comes from the Greek word mikros, which means small or individual. Macroeconomics means group or whole. The term macro comes from the Greek word makros, which means large or whole. Microeconomics is the study of particular firm, particular household, individual price, wages, income, individual industries, particular industries. Some of the theories which comes under microeconomics: the theory of individual market demand, theory of production of cost, theory of market price. Macroeconomics it deals with not with individual quantities such as but with aggregates of these quantities, not with individual income but with the national income. Some of the theories which comes under macroeconomic: theory of total output and employment, general price level, theory of inflation, theory of trade cycles, economic growth, etc. The example of micro and macroeconomics is that for micro it's only one. There's a tree, one tree of neem tree, and the macro is a whole tree, neem trees of the world of country. Yeah. Manager, a person who direct resources to achieve a stated goal. Economics, the science of making decisions and the presence of scarce resources. Managerial economics, the study of how to utilize scarce resources and the way that the most efficiently achieves a managerial goal. Managerial economics as a branch. A branch of economics, managerial economics, is the study of economics, theories, principles, and concepts which is used in the managerial decision making. Managerial economics is the application of various theories, concepts, and principles of economics in the business decisions. Definitions by authors. Managerial economics is the application of economic principles and methodologies to the decision making process within the firm or organization by adults. The application of economic theory and methods to business decision making in terms of finding the most efficient way of allocating scarce resources and reaching organization objectives by Cambridge University and by Dowell's. Managerial economic relation with economic theory, business function, decision science. A relation with the economic theory. This is related to the macroeconomic, deals with how market work and interaction between the various components of the economy. Relation with business function, production and operations. MIS means management information system, marketing, finance and accounting, human resources, others, or the relation with the business function. These are the functions which has a relation with the economy. A relation with decision science, a numerical and algebraic analysis, optimization, statistical estimation and forecasting, analysis of risk and uncertainty, discounting in the time value of money, techniques, and others. These include the decision relation with the decision science, accounting profit and economic profit. Profit is the reward to the owners of firm for taking risk, engaging in enterprise. It is the difference between revenue and costs. Total revenue. Total revenue is the income brought into the firm from selling its product. It is calculated by multiplying the price of the product times the quantity of output sold. Total revenue is equal to price into quantity. Accounting profit, also called bookkeeping profit, is the net income that remains after the subtracting all the gaps, all the in the income that remains after subtracting the explicit cost from a total revenue in accordance with the gap. Formula is accounting profit is equal to total revenue. Total revenue minus expenses cost. As a accounting profit, also known as the actual profit earned by a company during a particular financial year, is also known as accounting profit. Economic profit. Economic profit or loss to the difference between revenue received from the total sale of an output and the costs of all inputs used, as well as any opportunity cost. In calculating economic profit, opportunity cost, implicit cost, and expected costs are deducted from the revenue earned. It's the difference between revenue received from total sale, output, costs on inputs, means have been implemented or used on the production, has been deducted from them. Explicit costs. Explicit cost and economic profit or loss is the difference between revenue received from the total sale of an output and the costs of all inputs used, as well as any opportunity cost. And calculating economic profit, opportunity costs, implicit costs, and costs are deducted from the revenue earned. Examples of labor costs such as wages, inventory needed for a production, raw materials, transportation costs, sales and marketing costs, production costs. Implicit cost is what the firm must give up in order to use. It's also, in other words, an implicit cost is any cost that results from using an asset instead of renting, selling, or lending it. It represents the opportunity cost that arises when company use their internal resources. Explicit costs. Junaid wanted to open a restaurant in the city where he expected to earn 3 lakh per year. As he opened the restaurant, he would need the employees to work there, who would get the salary per year as 70,000. And rent is 1 lakh per year. If these figures are adequate, then it would be profitable to Junaid. First, find out the expected cost. Employee salary is 70,000. Restaurant rent is 1 lakh. Total expected cost is 1 lakh 70,000. Explicit cost sum. Subtracting the actual cost from the revenue. Revenue is 3 lakh. Absolute cost is 1 lakh 70,000. Accounting profit is 1 lakh 30,000. Actual cost sum. He has a job. He earned 1 lakh 20,000. Subtracting the envelope cost from the revenue. Economic profit revenue minus explicit cost minus implicit cost 3 lakh minus 170,000 minus 1 lakh 20,000. Profit is 10,000 per year. Time value of money. Interest rate, simple interest rate, compound interest rate, annuities. Time. It is an important element in our life. It allows us to do consumption and earn the interest. A fee paid for the use of another body money to the borrower. It's cost of renting money. Simply interest is payable on loans we get. Interest rate, the annualized cost of credit and or debit capital computed as a simply interest is payable on a loans we get on a percentage. Percentage simple interest, it is only computed on the original amount. Here borrower pays interest only on the funds used. Compound interest. Compound interest, interest is computed on the original amount to which interest earned to debt has been added. Simple interest formula. Simple interest, assume that you deposit as 1,000 in an account earning 7% as simple interest for 2 years. What is the calculated accumulated interest at the end of the second year? Formula principal amount into interest rate into number of years. It's the 140 at the end of second year. Simple interest future value. Future value is sum total which today's interest rate will grow by aspect of future debt when compounded at a given interest rate. FV is equal to P plus SI 100 plus 140. FE is equal to 1,140. Present value estimated current value of future amount to be received or paid out. P provide the common basis for comparing investment alternatives. I have deposited 1,000 in previous example. Annuity and its type. Annuity series of payments at fixed intervals guaranteed for the fixed number of years or the lifetime of one or more individuals. Ordinary annuity payment or receipt occur at the end of each period. Annuity D, payments or receipts occur at the beginning of each period. Example, student loan, car loan, insurance, mortgage, and retirement payments. Ordinary annuity FE, example, cash flow occur at the end of the period. Its answer is the FE is equal to is given here, and we multiply it. We plus all the years. 100 in first year, in the second year we got 170, and third year we got 1145 rupees, and totally is 3,215 rupees FEA. Example annuity due. FVA future value annuity due. There is FV is equal cash flow occur at the beginning of the period. This is also given. 1 year we got 1,017, and second we got 1,145, and second 1,225. Total 3,440 rupees future value of annuity. Demand and its analysis. Demand, the quantity of product that consumers are willing and able to purchase at a specific price and during a specific time. It is said to be a demand. Human desire for a commodity is called a demand, which has support of purchasing power. Demand analysis, for instance, demand price per kg 50, 40, 30, 20. Quantity demand 50, 100, 150, 120. 200. Demand table, demand analysis, demand curve. This is the demand curve. Lower demand. Consumer buy more goods when its uh, when its price is decreases, and less when its price increases. When price goes up, demand goes down. Price goes down, demand goes up. For instance, in our market, there's also when the price of a product goes up, people buy less of that product. When price of one product goes down, people buy more of that product. Demand and analysis. This is demand analysis, quantity demanded and price. Factors of demand: change in income. Change in income effect. The every people have a different price. Every person possesses a different money in their mind. They have one people have a 30 rupees, one people have a 50 rupees. They can buy with their perspective of product. Factors of demand: to price or availability of substitute effect. A substitute is the good that can be used instead of other goods, just as juices and pen. If I have a ball pen, I can use also a dollar pen. Price or availability of complementary goods. Goods are things that are often are sold or used together. Change change in the number of buyers. If there would be more people, there would be more sales. Now, if it's a change in tastes and preferences, our people possess different preferences and tastes, such as I like a mango juice, but my friend doesn't like it. Thanks for watching.